Looking at a chart, sometimes it can be extremely difficult to figure out what the market is trying to accomplish. But I'm about to give you a tool that is not only extremely accurate, but can be used every single day. And that tool is the 100 pip box is the price. Depending on the pip value or the tick value of any given asset, there is going to be a box that creates a 100 pip box. For example, here on the NASDAQ, we have the price of $15,000. And up here you can see the price of $15,100. And in between that, you're going to notice some smaller dotted lines here in which you will have 25 pip increments, giving you in total a 100 pip range or box. You have 25 right here, $15,025, 50, which would be $15,050, and then 75, which is going to be $15,075. Now, this can be performed on any given pair or asset or whatever you would like to call it. You just have to know what the pip value is. And then by looking at the chart, you can put up your 100 pip box using the indicator, which is on Discord. The link is in the description below. It is free. You just click on it, add it to favorites, and add it to your chart. So that means that from $15,000 to $15,100 would equal a 100 pip box. That area is used for institutional buying and selling. They use the outer extremities of that box for buying and selling, or the upper half or the lower half of the box for buying and selling. With any trading system, one of the most important things to focus on is the mindset of that methodology or that trading system. So for this one, we need to think about price always being in a box, always being in some sort of horizontal structure, and that the market only does three things. It's going to break out in trend, and you would look at range expansions of that box. So if you have a box, they break out, they begin to trend. That could be a range expansion of that box. You have breakout reverse, and when you have a breakout or a failed breakout, false break reversal, whatever you'd like to call it, looking for price to go back to the 50% or the 100% of that current consolidation. So like if we have a box and they break out, it fails, looking to go back to the 50% halfway of that box or back down to the other end of that box. Or you have a trading range. So price is just going up and down in a range. That would be a trading range. Consolidation between a high and a low, usually looking to avoid those scenarios. You need to remember that market movements are fractal. Everything happening on a higher time frame is happening far more frequently down on a lower time frame, and that's going to help you to try and conceptualize or visualize trend. So concepts are also fractal. So like the fact that I just talked about price being in a box, this is a 25 pip box, but what if the box was, 100 pips? Or what if you have a really large box, like the high and the low of the current year or the previous year? That's a box. What about the high and the low of the month? That's a box. High and low of the week, high and low of the day, high and low of the hour, the session, whatever it may be. Price is always in a box. Okay. The average stop hunt is 25 to 50 pips. This is very important. If you look up here on the screen, notice that we had a 50 pip consolidation down here. This is 75. This is 50. Price is free flowing in down here in this box, and then it breaks out. It pulls back and it continues to trend. We've got level 1, level 2, level 3. Now they come out of that box, level 3, 25 pips passed. All right, so the average stop hunt, 25 to 50 pips. This could go outside of consolidation. So like we have this box here, right? And they come out of consolidation, 25, 50 pips. And that is the extension of the three levels of rise. Now, you could also have 25 to 50 pip stop hunts against the trend. Like, for example, notice how this is going up, and the pullback is 25 to 50 pips. And pullbacks, the concept of a pullback, this part's very important. The concept of a pullback, what is it trying to accomplish? The market in a pullback, which is what this is shaking out the people that have the trade correct, the direction correct. They're stop hunting against people who have the trade correct but have timed it incorrectly or have brought their stops up too aggressively to break even, and they are now inducing people to take the other side of the trade. That is the purpose of a stop hunt or a pullback, and that is going to, on average, be 25 to 50 pips. And finally, a very important mindset piece to have is that all market movements are timed and measured. That is why we use this system of identifying strike zones, because everything is measured. All right, yeah, it's looking pretty good. Like what I'm seeing. Okay, time to go long. Whoa. All right. What? No. Oh, okay. Yeah. Now that we have our mindset down, I'm going to show you what areas and when to actually use the 100 pip box. And I said it in the intro, but the 100 pip box is not necessarily a just use it whenever kind of thing. It's actually something that you can use every single day. Now, the way that you do that is you can just simply measure from these areas that I have up on the screen, 1 through 5. All right. We have signal days. We have weekly template trades and all of these different things that we're looking for throughout the week. However, this is one way or an added confluence that you could add to those trading setups. I'm going to say that again because it's very important. I do not use the 100 pip box as a sole thing. It's not the only thing or the only detail that I go into a trade setup with. I've always got something like first red day, first green day, inside day, some other weekly template trading setup, and then I use the 100 pip box on a daily basis to help me to identify the most high probability area of the chart to take my trade. It gives you a strike zone and it gives you high probability areas for you to take your trade. So some of those areas can be measuring from the low of the day or the high of the day in a trend in order to identify potentially overextended markets looking for reversal and counter trend trades. I can measure from the low of the day in a trend in order to identify trend continuations. I'm going to measure from a breakout level, such as it could be like a previous day's high or a previous day's low, or it could be the high of London or the low of London, and measuring 3 levels from that breakout in a direction and look for a reversal or a counter trend trade from that area. Measure from the previous day's high of day or low of day and look for a trend continuation. A lot of times you'll see this where the market dumps and then they pull off of that low, and then you measure from the previous day's low of day up 3 levels. They'll go into consolidation at level 3, and then it will dump back down to that previous day's low. And of course, you can flip the market over. They go up to the high and pull off the high. It's the same exact thing, just in the opposite direction. You can also measure from the current high of week or the low of the week, looking for high of week, low of week reversals. So let's say like Monday, the market starts trading down. All right. But you notice that Monday was in a 100 pip box or maybe a 50 pip box. They've consolidated and you measure down from that area from the high of the week. It's basically an assistant to your weekly template trade setups. You measure down or up depending on the direction, right? And it will again help you to find decent strike zones for your trades. Regardless of where you measure from, step 1 should always to be identifying the initial consolidation from where the market broke out of and started moving unidirectionally. So like, for example, notice that this is the previous day's high over here. All right. You can also see this really dark red line right here is double zeros. They moved through that level and they actually at the beginning of the day went into consolidation. They're in a 50 pip box. How do I know that they're in a 50 pip box? Well, just look at the price. They've been going free flowing back and forth in that box. And depending if you're on an index or a currency pair, usually what I'll do is I'll say, hey, for a minimum on an index is going to be probably 50 pips, right? Because that's, it's more volatile. With a lot less volatile pair, looking for 25 pips increments is more normal. So this is going to give you a ground level. The consolidation is ground level. You're measuring up from the breakout level, but I still need a ground level of some kind. So they give me a 50 pip box, and then I'm going to measure from that point 50 pip increments up. So you can see my boxes here, 50 pips, 50 and 50, giving me 3 levels of rise or a strike zone or a potential area for me to get my trade. Now, if you've ever listened to any of my other videos, you know that I have a very specific set of criteria that the market must go through. And here it is. This slide right here is from the previous slide, but zoomed in, and you can kind of get a better idea of everything that needs to happen before I'm allowed to take this trade. Step 1. We're in level 3. Great. We can just check that box. Like I said, that gives you a strike zone, but not necessarily a guarantee, hey, I'm looking to take a trade in that area. But reading this from left to right like a book, I have institutional signatures on the chart that I've labeled off. So over here, note 3 push behavior into level 3, market maker behavior. So this big blue box here, notice the candles. Candles are so important. Up into level 3, the black box right here is level 3. Big candle lifting price up high. Okay. And then you have push 1, push 2. Again, candles lifting price into the high. And then push 3, lifting price into the high. One last time, making higher highs and higher lows until finally, boom, break in structure. We get a lower low. Now, something to always just be playing over and over in your head at all times. The first push will get my attention. The second push makes traders take action. Think about human behaviors and just human reactions to certain things happening. Also, this second push right here broke a high, which means there's breakout traders going long off of this candle. And then on the third push, same exact behavior, but the third push makes you take action in the worst possible place of the chart. That's going to be the trap. That's going to be the area of the chart where they will not let traders out, or they should not let traders out, and that's the behavior that I'm searching for. Looking to the right, after the break-in structure to the downside, I need to see 3 pushes back up into this high right here. And that just so happens to be back up into level 3 as well. So break-in structure to the downside. Then I have push 1 back up, push 2. Notice how the candles got real big for push 1, then there's a pause candle in the middle, then push 2 gets real big again. Push 2 makes me take action. I've now bought this stop hunt or this pullback back up into the high. Push 3, I bought it the worst possible place possible. Wow, that's a lot of possibles. Is what it is. Then the market breaks down. Notice that this candle right here engulfs the closing price of these 2 candles right here, which means that they may have just got people stuck up there. Now, there will be times where I take this entry, and in this past week, this is an entry that I did actually take. Also, I'm taking entries at this level right here, which is 75, and taking this short trade back down through 50 and trying to get back down to 25, but I didn't quite get there, and I ended up getting out down here in these candles. No big deal. Still a really great trade, and it was all about behavior and, of course, my entry criteria. Within the pullback after the break-in structure, note the candle behavior. Stop hunts against traders who are short, induce longs, and shake out shorts. Like I said, the purpose of a pullback. The 100 pip box is something that can be used every single day. This is another example of that. All of these examples were from this past week or the week before, all right? And these were all taken with or on the NASDAQ, right? So notice market structure, right? Context of the market's always very important. This is a Monday. So this is a break-in structure on a Monday. We got Friday's low down here. And then notice the 100 pip box that I've used. You have a ground level up here, which could also, you could argue that maybe you're level 3 down here. Maybe this is ground level, whatever you'd like to say. However, there's a break-in structure to the upside. So what am I doing here by saying that? Well, if there's a break-in structure to the upside, maybe I want to measure from ground level 3 levels down to look for a long trade or a continuation of that trend. You know, you got 3 pushes down, push 1, push 2, push 3 into consolidation at the low of the day in level 3 or down to level 3 for a trend trade back up into the ground level. Basically a long trade off of London. Now, once you get back up into ground level, well, that's 3 levels of rise off of the low of the day, and you've got consolidation down here back up into level 3, which leads me into this example here. All right, level 3 at the high of the previous day, that was the ground level before. Now it could be considered level 3. We've done 3 levels of rise off of the low of the day at this point. And now, again, coming back to institutional and market maker behavior into level 3 right here just before the session begins. On the 1-minute chart, push 1, sideways, push 2. I have now bought the market. Breakout traders are in. Push 3, bought in the worst possible place. Look at the candles. They're lifting price each time, and now they have dumped it, and they have possibly just got everyone who bought at the worst possible time, and now they are stuck. So I look for institutional selling at this area. This is a good pattern. 3 pushes, break in structure to the downside. Now I need to see 3 pushes back up. Push 1, push 2, push 3. Now I need to be after 9:30. Equity market opens, very important to me. So there's a break of structure, trend continuation down, and 3 pushes back up. Now, that's all fine and dandy. What I want to really point out is that look at where these levels are coming up to, right? So if I box this off of where I think that people are buying based off of the candle close behavior, right? Look at this candle, how it closed, and then all of these candles, how they're closing. Again, institutional selling market maker behavior. When they dropped it away from those levels, they broke structure to the downside. Do you notice how they don't go back up and let those people out of their positions? That is the behavior that I'm searching for. Then it drops away, makes an even lower low. And again, when they stop hunt back up, they don't let people out. Push 1, push 2, push 3, marking off. You can see my second little blue box here, not letting those people out and then engulfing again back down to the downside. Fantastic place to enter and allow that trade to play out the rest of the way. And actually getting back to what the slide is saying over here on the left, I want you to think about the flow of information or the way that you go about taking trade setups as almost kind of like a symmetrical triangle, all right? Where the side, this side over here, the triangle, and it comes up like this, right? It's a flow of information. The biggest portion of the triangle over here would be like 1 and 2, all right? So like as we narrow things down in the triangle, things are starting to squeeze and you're getting closer to your entry. Things are going to start to become more clear. So like number 1 right here, identify a 15-minute trade setup. That's pretty broad spectrum, the big wide portion of the triangle, right? Marking off the levels, that's very consistent. I do the same exact levels every single day. Market structure, high and low, major, minor. Previous sessions, high and low. So like I trade New York, so I would mark off the high and the low of London session. The gap time, high and low. Do the same thing every day as long as it makes sense. Like here, the gap time high and the low makes sense. Here's the gap time high. It's a good thing I would have marked that off because there's the third push. And then the break in structure. It's important to mark those levels off. Then I want to mark off my first hour high and low. The first hour of my trading session. Here's 9 o'clock. Mark off the high. Mark off the low before 9 o'clock. Because that is the opening range for the session. Going back to like the very first slide of this presentation, market only does 3 things: breakout, pullback, trend, breakout, reverse, failed breakout, 50%, 100% of the consolidation. So if this would have been a failed breakout, they would have gone back up to the 50% or the other side of that range. That's not what happened. Or, you know, it just stays inside of a trading range, and obviously that's not what's happening because they are breaking out currently and not staying inside or range bound. So now let's narrow it down to the next portion of the triangle, right? Observe and measure your 3 levels. That's something you can do every single day. Even if the 3 levels doesn't necessarily play out the way you would expect, you still have all these other things as confluence. But if the 3 levels does play out, let's say you're in level 3 at 9:30, hey, that's just an added confluence or an added thing that you can look at or look for your trade to make it more accurate. Also, the time of day, like I just mentioned, you want the equity market to be open, and you don't want any major red news left on the calendar. It should just be you and price trading organically. There should be nothing else that is, hindering your trade from moving as it should. And then, of course, understanding, and probably the most important thing that I could ever tell you in any of my videos ever at any point in time, is to understand what the behavior of other human beings is. Where are people getting emotional? How are they getting emotional? Why are they getting emotional? What is the market trying to accomplish? Trying to get people to buy? Are they trying to get people to sell? And then combine all of that human behavior aspect to your entry criteria. So that way, again, just making it far more accurate. And if you want more details on human behaviors of candles and price and all that stuff, go watch this video. It's linked right here. Also, this slideshow is linked down in the description below. You can download it, save it forever. It's yours. One thing that's going to vary between the different pairs is the volatility. All right, so like oil, gold, and indexes, it is not uncommon to see something move in 3 levels of like 100 pips. Okay, so a lot of times my goal or my idea is that I should have a 50 pip minimum on those pairs. I have a currency pair where the volatility is much lower. I don't want to use levels of 50 because the average daily range might only be like 25 to 50 pips. That's not going to accurately measure your trade, right? With gold, oil indexes, 50 pips minimum. However, it's not uncommon to see those things move in 100 pip increments. Currencies, 25 pips is fine. Some of the more volatile currency pairs will move in 50 pip increments. Just get really good at identifying the ground level and then measuring up equidistance from that ground level into level 3. And that brings me to this example over here where you can see the 25 to 50 pips outside of level 3. And then that was a stop hunt or an inducement maneuver to get people to go long. The M, and then it breaks down, breaks structure, pulls back, and then boom, you get your trade back down to the ground level. All right, big takeaways from this video are going to be get really good at identifying those ground levels and the distance that they have traveled. If it's a 50 pip box, make sure you're measuring in 50 pip increments. It's a 25 pip box, make sure you're measuring 25 pip increments. This is something that can be used every single day, but it is not meant to be used sole purpose to find trade setups, right? You need to make sure that you're combining this with other large trade setups like first red day, first green day, weekly template trades based off the opening range, etc. And also making sure that you pay attention to human behavior. Once you're narrowing down that symmetrical triangle of information and you're about to take your trade, make sure that you have factored in the human aspect. Where are traders trapped? Why? Does it make sense for them to move from the direction that, or in the direction that they're going right now? Are traders trapped? Am I taking the right side of the trade? Are they letting my side of the trade out? Let's say I want to take a short. Are they letting shorts out of the market? Identify those big spiky candles and see and like, hey, are they letting people out of the market? If yes, then this is probably a higher probability setup. And all of those things in combination with one another will equal a really great trade. Ladies and gentlemen, I really do hope this video has been of use to somebody. If it has, let me know down in the comments below. Hit that like button, subscribe to the channel if you have not already, and enjoy the rest of your day.